Hello, and you're welcome to this special edition of Global Business Insights, where we're looking at Nigeria's inflation, May 2024 inflation data that just came out today. Nigeria May 2024 headline inflation rate increased to 33.95% relative to the April 2024 print, which was 33.69%. On the contrary, on a month-on-month basis, the headline inflation rate for May was 2.14, which was 0.15% lower than the rate recorded in April 2024, which was 2.29%. The food inflation rate in May 2024 continued to creep up. It was 40.66% on a year-on-year basis, 15.84% higher than a year ago. May 2024, the urban inflation rate was 36.34%, while rural inflation in May came in at 31.82%. Business analyst Lekon Shote is here to share some of his thoughts on the latest data.
No one should really be surprised that inflation in Nigeria continues to rise. Just last year, the foreign exchange regime was reformed so that the naira finds its own level, which then means that market prices will reflect the depreciation of the naira. This is an import-oriented economy, and there's nothing we can do about that. Then, of course, you recall that also last year, as the president was making his inaugural speech on May 29 last year, he actually reminded us that fuel subsidy is gone. Okay, so removal of subsidy then means that market forces would probably likely be determining the cost of or the price of petroleum products, especially petrol, what is called PMS. And then just not too long ago, less than 2 months now, the electricity sector also came with its own reform, with its removal of subsidy. Again, this will be reflected in the prices of our commodities. Every organization that uses energy will want to recover their costs, energy costs. So you shouldn't be surprised. And finally, another problem is that this hue and cry, this noise about new national minimum wage. As long as the media keeps hyping information about it, those who sell goods, they are also wary and aware. Those who also manufacture, they know that their costs of production is going to rise. And so they are already pushing what you might call anticipatory pricing into the market. And I think it's going to also get worse when the national minimum wage is finally settled. It means more money is coming to the economy with, if you like, an elastic supply regime, which is not very good. So it means that inflation is going to really increase. What to do? How to get out of this? Very easy. Difficult, but it's easy to identify. Those who are in charge of fiscal policies, those who are in charge of macroeconomic policies, all they need to do is very easy. First thing is those who are managing Nigeria's oil sector need to find a way to quickly raise the production of petroleum so that we can at least meet our OPEC quota, and then we can earn more foreign exchange. And then that should reduce the pressure on the naira. That's one. Number two is that the productive sector is not producing anything. As a matter of fact, a lot of companies are getting out of Nigeria. So those who run the economy have to be thinking very quickly of how to retain industries, manufacturers of consumer goods, fast-moving consumer goods that are already in Nigeria, and then developing homegrown manufacturers. The idea of thinking you invite foreigners or what you call foreign direct investors, when you have not quite tidied up, your economy, I think we need to. Security is a problem. Shortage of practically of even the energy is a problem. So we need to get those who run the economy to pay attention to those details. We need to start producing foods, at least the more strategic consumer products, which is foodstuff. If we can produce that, that will reduce the pressure on the foreign exchange, and then of course it should positively affect the price of goods, consumer strategic consumer goods, the foodstuffs. And then, of course, if you are able to run the refineries, thank God the Dangote refinery promises to come on steam. I think in July, which is just next month. If that happens, it should reduce the pressure on the naira.
There are initiatives that could offer relief on price pressures as Nigeria considers the inflationary measures like suspending import duties on some food items, on drugs and other essential items for 6 months. On the other hand, signaled expectations that the minimum wage for workers are going up may also be fueling hiking of prices. The data is not all bad news, although a 28-year high at 33.95%, pretty much as expected for headline inflation and food inflation at 40.66%, making it about 10 years of double-digit inflation since December 2015, when inflation was 9.6%, easily the worst economic period in recent history. But the good news is that one, base effect could, or I should say should, drag the next set of annual inflation measures down. The base effect, just to explain, is a distortion that occurs as we compare inflation figures from a base a year ago, where we saw the first impacts of devaluation on inflation and a spike in month-on-month price increases. Other good news, S&P Stanbic PMI May release predicts they expect to see inflation begin to trend down after this reading. That's also confirmed by analysts at Trading Economics looking at their predictions. The grey shaded areas show that by June 2024, inflation should be 33.5%. By December, inflation should be down to 25%. Global Business Insight in January had predicted inflation would go to 23 to 25% by December. The central bank is targeting 21%. It's not too ambitious what the central bank is looking for. If we get inflation coming in the 21 to 25% range, that would be considered a lot of progress and builds credibility in a difficult transition requiring much structural adjustment that will have medium and longer term stability implications. That is on the positive side. Additionally, if you look at the chart showing the month-on-month inflation chart, we see month-on-month inflation coming down since February at 3.1%. That's what we had February 2024. Today it's 2.14. But we can also see a slowing descent in the tangent of the fall in month-on-month inflation, which suggests some stickiness. Predicting inflation is a hazardous venture. Even institutions with the most comprehensive analytics and forecasting models often acknowledge that they may just want to wait for the actual data to confirm the trajectory. But let's be clear, as plans to rebase GDP growth progress and may paint a better picture, actual economic activity and employment and consumption will be weighed down by inflation, especially if you don't see inflation coming down. In May 2018, PMI in Nigeria peaked at 59.1 points. That was May 2018, when inflation was 11.61%. The latest Stanbic IBTC Bank Nigeria PMI rose marginally to 52.1 in May. That's May 2024, up from 51.1 in the prior month. So we are seeing some resilience, but clearly you can't have improved or enhanced economic activity if inflation is ticking up. The confirmation of inflation peaking in May from the next few months' readings is therefore important to understanding how the economic growth trajectory for 2024 is likely to be. The next inflation read is key to the central bank's July 22-23 MPC meeting, where there is a chance of a pause if we see the June reading showing a drop inflation, albeit a marginal one. Still on Nigeria, the president is intent on plugging the leakages, which helps to improve productivity and bridge infrastructure gaps. Both are key to reducing inflation. The president today directed the resignation of the Director General of the Bureau of Public Procurement and called for a repositioning of the agency. Well, that's it from me on this special episode. Thanks for watching, and remember, of course, on Monday we continue to bring you the latest from business headlines all over the world. Enjoy your weekend. Bye-bye.